All right. Good morning. Good morning, everybody. So we're getting a little bit of a bounce this morning, potentially a DCB dead cat bounce. There's been two real things that could cause an upside flash crash upwards rather than downwards. And one of those two things would be an end to the hostilities between Russia and Ukraine. The other one would be a complete shutdown of the COVID-0 policy over in China. Either one of those two situations have the capacity to really explode this market to the upside. And it's been, kind of front and center in everything that we do, knowing that, okay, yeah, we can carry shorts in the market, but we still always need to protect ourselves against these two possibilities. And what we're seeing here this morning is yet again some subtle hint that negotiations might change the current situation between the Russia-Ukraine. I had made a comment on my weekend briefing 2 weeks ago when Russia had released that American citizen that was arrested and that they were detaining. Her arrest coincided with the invasion into Ukraine, kind of holding, I don't know, there's a lot to that one, but they released her 2 weeks ago. And I had wrote, keep your eye out for any kind of talk suggesting a change in market or in the war efforts. Sure enough, here we are now. This isn't the first time they've made these kind of overtures, so it does not really mean anything yet. It has to actually, get an outcome, but this would not surprise me if we see an upside explosion out of this. We do got some reasonable amount of data today, including crude inventories. With the global energy situation, it's really worth keeping your eye on this. So at 10:30 today, we have that coming out. Not a lot of Fed speakers still, which is kind of nice, but a little bit of a surprise. I was really expecting they would be out here chipping their teeth by now. A little bit of a quiet day, it seems. Not necessarily a bad thing. Bank of Canada is going to have its CPI this morning at 8:30. It has the capacity to reverberate around the world. If they get an outlier number, not really expecting that, but, watch the clock. Like I always say, watch the clock. By 10:30 today, we will have the econ that we're going to have for the day. So your 0 day this afternoon, it should be wide open once we get through lunch. We're not there yet. Still looking for a completion of this breakout, this rising wedge breakdown. Now, it doesn't have to give us the whole move. A lot of times a market will only give you 50% of the move. and we have more than that. Generally, though, if you're going to only get 50%, that honestly is all you get. You don't typically see it make a 65% move and then, reverberate back up. But we could overshoot from the 50, I guess. It's absolutely possible. We've also got a minor inverted head and shoulders forming along this level. Bit like that. So we're going to be looking for a neckline breakover somewhere around that 38.70 if we're going to see that head and shoulders. And the measured move on that puts us back up to around 39.35. All right, one thing that this volume tool does is kind of gives you an idea of how impactful the market thinks some bit of data is going to be, like that Canadian CPI. If they were more worried about the Canadian CPI, we would have a much lower cumulative overnight volume. Everybody would be sitting and waiting for the Canadian CPI before getting into the market. Kind of like how we were sitting and waiting last on Monday with this really low volume at 70. Right, the market was waiting on something. We're not in extremely low volume, so it implies that the Canadian CPI is not expected to be as impactful as, say, our CPI. So it's just a nice little reassurance, right? That doesn't mean that it couldn't surprise and then shake the market, but our CPI doesn't have to surprise at all, and it can still shake the market. All right, so we got a very narrow IB. It's another way of saying that the 1 hour open range is very muted. We didn't really move around much last night. It's a very tight consolidation. This implies there's still a lot of work to do. If you think about it from, say, just random Joe Schmo, he gets the orders, gets the email in the morning, says, I need you to execute this many contracts today. He hasn't got his work done yet. We're continuing to threaten an inside day breakout. We're just hovering right there on the edges. Which kind of implies we have the capacity to continue to roll over and head lower, right? If this was bullish, where is everybody? You can see how we continue to hover really close to the VWAP. The VWAP is this dashed line here. So really gentle swings, high to low, low to high, high to low, just crisscrossing back and forth that VWAP. This is a market imbalance. And until this balance ends, this is what we're going to continue to see, right? The market's happy with these prices, and there's two-sided trading going on. Major institutions are unloading, other major institutions are picking it up. We don't have a clear direction, and we don't have a single message to follow. Until we get that, it's really advised to just sit on the sidelines and wait for something to unfold, right? Some one-time framing or, a single market structure, a consistent message, something more than just that. The ADR is 1.94. That's around a $75 move. So to the upside, that's 38.94 and 39.32. It puts us right at the top of this range from last Friday. It's amazing how all this stuff just measures out on its own, ties into existing structure. To the downside, 38.19 and 37.83. The low of yesterday is right at 3,800. This is a critical level that has to be defended. There's also a massive put wall right there. This put wall was at 3,900. Once we breached that, it got moved down to 3,800. Should we breach that, it's going to move down to 3,700. That's how it goes, right? That's the way things work. There is a massive JP Morgan collar, which I used to pay a lot of attention to. I really don't pay too much attention to it anymore, but it is somewhere in this zone. We're flirting with it. As we get closer to expiration, that JP Morgan collar may become more pertinent, but for right now, just knowing that it exists and where can kind of often provide a little bit of insight, right? So all week we've done nothing. Up to this point, we've gone nowhere. We've accomplished nothing. And we're really looking for a resolution of this one way or the other. So a break above our ADR high would get us out of the Monday range and into some new highs on the week. And getting below 3,800 would be new lows on the week. The week is still young, relatively speaking, right? About halfway through. Doesn't feel like it. So if you're looking to avoid getting chopped up, you could just sit back and wait for the market to leave this range. And I'm going to continue to argue, just because of the current situation where there are so many, excuse me, there are so many diverse point of views right now, extreme, heavily weighed point of views, that we might not go anywhere. We could just stay in this box for the rest of the week. Now, I find that hard to come to terms with, right? That there's three things price can do. Simple and easy. You know, we can go up, we can go down, we can stay the course. It really is just as simple as that. We could just sit here for the rest of the week and do nothing. That is on the table. A break to the upside out of this range. That's actually something we can measure. 39.46, call it 39.50. And then this really big candle. 39.75. One thing of note when it comes to this is that we made it to the 50% mark and closed above it, kind of implying that this time around, at least for right now, we're not going to go to the 200. In a measured move, 50% is the first stop, and then 100% is the second stop. And generally what you get is, if you stall at 50%, you're not going to get 100, right? Now, that's not a guarantee. We could just get a little bit of a Busby here and then continue to move to the downside, like a little bit of a dead cat bounce. If we're going to maintain our bearish posture, it has to stay below 39.75. It has to. If we get above that and we close above it, then we have to discount this breakdown. We'll have to discount that the rising wedge is done, and that we need something else. So 39.75 is a long ways off, considering where we're at right now. It's about 100 points away. But that's within our reach. When we're at the bottom of the box, we expect to go to the top. When we're at the top, we expect to go to the bottom. This is a 10-day, 30-minute volume profile. If you're looking for one for the swing instead of a short duration like a day trade, the 1 hour 20-day is a really good volume profile setup. It'll look exactly like this, just change the day, 60-minute 20-day instead of 30-minute 10-day. Corey Rosenblum wrote a book. He wrote a couple books, and I don't remember which one it's in, but in one of his books, this setup came from his book. TPO in blue, and volume profile in green, volume by time and volume by price. The point of control, 39, 35, 38. We would have to get through that for any kind of move back up to the top of the box. We have a little bit of volume support underneath this at 38.55-ish, right around in there. Just keep in mind, this isn't the kind of support you would want to lean on and trust, right? It's not a handrail. Don't expect it to hold price up. It's more of like a supply and demand rather than support and resistance, right? So could see a reaction in price if we were to come down and retest that 38.50 area, but I wouldn't trust it to support the market. First touch play, obviously, if we come down and bounce off of it, it'd be a nice day done. Otherwise, if we stay above it, we're going to continue to focus on the point of control, 39.37. We get through all the trash, say around 4,000, clear skies. It really shallows up, and we should be able to march back up into the 4,100. Obviously not in one day, right? Take time to work our way back up. The volume profile is going to stay this wide for at least another week. Keep in mind, this is the last full trading week of 2022, right? We've got short weeks into the end of the year after this. But until next Tuesday, the volume profile will remain at least this wide. And of course, it can go wider. All we have to do is break to the downside or expand beyond the top. 5-day, 5-minute volume profile. I call this mapping out the 5x5. You can see this morning how clear that looks, right? How absolutely narrow our range is. This is a market looking for a reason. If we break through our own Globex high, 3,900 is on the table for me. And if we break back down through our Globex low, 3,800 is on the table. It really is just as clear as that, right? So the age-old question, have we gone too far, too fast? Are we oversold? Nope, not yet. That's the 10-day. Here's the 10-week, also implying we are not oversold. We have the capacity or the potential to continue to move to the downside considerably. We're nowhere near the edges of the basketball court. So we're going to be looking at a dead cat bounce today in a lot of names. You can see how we've got prices coming down into their 50-day moving average. So some of them have broke through, but a lot of the others like staples, healthcare, building materials, they're going to be getting that bounce today. All right. It's more of like a relief rally, come into support, get a little bit of a churn, some consolidation, a bounce, rally up into resistance, roll over, dump back down, break through the previous low, get new lows. It's just continuing cycle. So we're expecting that upside move today. It kind of completes, the move from the other day. Just look back at regular market structure. Okay, you get the rollover, you get 1 or 2 days of basing, a little bit of a bounce up. And then, depending on the directional bias of the market itself, we're going to continue to move higher, or we roll over and continue to move to the downside. We haven't had a big day in a few days, which kind of puts that on the table too. So just for a kind of maybe, if our regular ADR is 1.9, what would it look like if we got a little rowdy today? A 3% move from the Globex Open would put us at 39.75-ish. No reason to split hairs. And a 3% move to the downside would put us at around 37.40. So now we've got one more level beyond our normal standard deviation. Volatility just isn't registering worth a darn. Really not helpful. $27 is what the SPX has, and we can add 27 to the market maker move, 19. Get you around 46. 46-point move up or 46-point move down. That doesn't even come close to the kind of risk we're facing today on any day that we've been seeing lately. Same thing with the ES futures. Wednesday, the 0-day sitting at around 27, we'll call it 28, with no market maker move at all. We obviously have the capacity to move farther than 28 points in the ES on a day-to-day basis. So those are not helpful right now, which is why we use the ADR instead. Just looking back, what have we done over the past 21 days? How far has the market traveled from the highest point to the lowest point? That's going to give us a better gauge on how far we could move today. So really, you want to avoid getting chopped up, get out of this box. I mean, there's no better way to say it than that. I've mentioned before that you can break these down into zones. So if you were to use a zone from our own Globex high to Globex low, and then another zone from that low to say the RTH low, that would be a zone. And then a zone from the entire low of yesterday up to the RTH low, that would be a zone. Now you've broken that trading day into 3 pieces. Really looks like we're just about to get a nice little breakout this morning. Sorry about that. I was getting set up on my other machine. I'm going to catch this trade while I'm doing the morning briefing. Why not? All right. Anyways. Let's see what else is moving around out here. Natural gas getting another reflexive bounce in the other direction, more than 2.25. Followed by energy, oil and gas, more oil, home construction, and finance. Even a little bit of K-Web this morning, but emerging markets basically doing the opposite. So I want to see those two kind of sync up a little bit. Very likely going to see a little bit of a reflexive move back in gold and silver too. Healthcare is getting a little bit of action this morning, and so are bonds. Although that's kind of a carryover from yesterday, but still, it's a high sizzle. And that has to be a carryover from yesterday. Cloud almost never gets pre-market action. Yeah, that's a carryover. All right, there's the breakout. Well, the NASDAQ is really taking second, sitting in the back seat. The ES is making this move. The difference between these two is financials, right? So as we dig through here, it's very likely that we're going to find financials are moving around better than, say, mega market cap names and such. Otherwise, these two would both be trying to break out of that range at the same time. We're seeing a fade in the Dixie this morning, and the VIX trying to press into new lows. US dollar China coming up into my monthly level, which makes sense. We get a rejection here, move to the downside. It's a ratio chart, right? So US dollar slash China, meaning when it goes up, the dollar is doing better, and when it goes down, the dollar is doing worse. Well, if it's going down, and the dollar's going down. So a little bit of a rejection on the 4-period moving average, a rejection on the monthly level, a rejection that we've seen coming, matched with a market pressing at resistance. But we're not getting that follow through, which has been my argument now for a couple of weeks, that we're seeing moves in the dollar that are not reciprocated in the rest of the market, like that teeter-totter we always talk about. It's not a teeter-totter, and we're getting a bigger disconnect every day from the moves that we're seeing in the dollar to the anticipated moves that are not happening in the S&P and the NASDAQ. So for the dollar, we're very likely going to need to break below yesterday's low before we actually start to see any effects or the ramifications of that coming through into the NASDAQ and the S&P. And instead, you're much more likely to see some assistance out of the VIX. So this is why I talk about looking at multiple places, looking at multiple sources when it comes to economic events on the day. There is a 20-year bond auction today at 1 o'clock. It didn't show up on the side here, and it didn't show up in Thinkorswim, but it's listed down here. Most of the time, all of the places are going to have the same information, but every once in a while, something slips through the cracks. And so be careful today at 1 o'clock. Watch the clock closely. We've got a 20-year bond auction. The 20-year is not, the most widely watched, but, it's more popular than those 4-week, 13-week, really close front end bond. So yeah, watch the clock today at 1. We could see a significant change in market structure coming through, especially with what we've been seeing going on in the FX market with, Japan widening that channel around their zero rate. Energy is looking really good this morning across the board. solar's down. And commodities. All right, we're getting that reflexive bounce in all of the chip names. The curve starts right around NVIDIA, Qualcomm, MU, AMD, and then on up the list. Some that haven't quite hit our benchmark, TSM, SMH. Those are two big players that I'd want to see, for any kind of play this morning. In the EV space, Ford, GM, NIO, those are kind of the lower end of the curve, Li Auto, and then higher up, Rivian, Lucid, Tesla. Not a surprise on Tesla too. That thing has had a significant move to the downside. It's almost due, right? When we talk about overbought and oversold, I'd say this is due for a dead cat bounce at this point. Just keep in mind something as simple as a 10 period daily or a 10 period, 20 period daily. Those can be just real simple visuals or guides. A rally up into a descending moving average like that, just like we had back here, maybe punching through it a little bit, but not able to keep it, stick the move. If we're looking for how far this bounce could go up, those are two good targets to aim for, especially when the 20 lines up with this pivot back here. So around 167. This is a TRB setup. Generally, we'd want 1 or 2 days of basing first and then the crossover. So if you're looking for a counter trend trade, like a dead cat bounce play, Tesla crossing above the 3 or the 4 period daily moving average would be a good trigger for a short-term move back up. If you want to be a little more cautious, then, waiting for the 410 to cross or for price to break out of this really big red candle from yesterday. I don't like to wait that long on a counter trend play. And there's still an expectation that we're going to base, if this was the spot where we're going to consolidate for a little bit and move in a counter trend play, we're more likely to see it base down here for a few days and then make a move up, right? Otherwise, what it creates is this V shape. Since KWeb didn't really have a lot showing this morning, it's hard to see how NEO is going to give us a lot either. But, you know, it is on support. It's had a nice move down over the last few days. We could be looking for a reflexive bounce off support back up into resistance before the rollover. So far from what we're seeing, energy is going to be your best play, especially if energy fails and starts to dump, right? If we're going to continue to move to the downside, something that's already up 2% would be a great short. I'd rather short from the highs than short from the lows. Through most of 2022, the intraday trades that offered the best opportunities from the way that I trade, my style, was more from financials and energy than anything else. Bank of America breakout above 32.5 would be a nice run up to, say, 33, 33.5. That might not sound like much, but it's a small stock, right? It's not a very expensive company. We're not going to be expecting, 10% moves on the day. With Bank of America, watch out for 33.75. It's last week's high, and it's very close to 50% of that really big candle. If we're going to maintain our bearish posture here, we have every expectation that we will not get through the 50% mark on this really big week. And that lines up at just about 34, maybe a little more. So in a rally today, if we get up to last week's high, look for that rejection zone, consolidation, reversal. That should shut it down. And if it doesn't, then we're going to focus on 50% of that week. A breakout above that, we'll target the high of the week, right? Because if we get through the 50% mark, we're headed to the top of it. But these are weekly candles, and we need daily closes if you're looking for, confirming triggers for a swing trade. All right, we're looking for a TRB here in Amazon. We're on the daily chart. a good starting point would be breaking out of this doji candle. And then, oh, what's the name of this thing? The popcorn. I always forget the name of it. It's Rob Smith from the Strat, where he talks about, making this breakout play and triggering all the stops here, which fuels the fire, and then triggering all the stops there, which adds to the fire, triggering all the stops there. And it just keeps going, right? It just keeps squeezing and popping through all those levels and layers. There is a gap to close. At 88. Pretty close to 88. And another one at 91. Channel bottom at 90. All right, so that little gray box that I drew, that's all of yesterday. And price right now is getting ready to break out of yesterday's range. So we're going to get an inside day breakout and start working on 87.5. And then it'll just be level by level all the way through all these zones. And the TRB, I wouldn't stress on trying to draw it perfectly, is just the idea that you're going to get a trend line breakover. And you might get a little bit of a pullback, right? Get a breakout of yesterday's high, a little bit of a pullback, and then a continuation. And it's like this hourly cup. And that pullback would be a part of your handle on that cup. Once you get the handle, then you start on the trend side and a move back up through these levels. It's still all just counter trend, right? It's not like we're taking long-term swings and Amazon to the upside. The range is still very defined at 90, call it 95, 96. What we want to see is a morning star reversal and a gap up with a Haramni preferably. So on this gap up at the open, no wick to the downside and just a solid move up out of 87.5 would kind of confirm that we're in that Haramni candle. And then the follow through up through these zones. That's a nice reversal setup. Short-term counter trend. NVIDIA is another one, has the potential. It's the same setup. Morningstar reversal. Looking for a gap up. We're already at 162.30. Now 162 and a little bit of change. So we're not quite inside day breakout. First step, break out of this box. Maybe test the top of it as support once we're through it, and then work through every one of these levels. The gap is a long ways off. So, probably not going to make that today. I don't even think it owes us that much. So with this and that little bit of news coming out of the Russia-Ukraine situation. We could see a nice little pop to the upside today. Some of these names are sitting on some good support after a, that 5-bar rule, for an example. And the kind of day that we're looking for is a day like this. So you get a mild trendline breakover, a nice gap up, start breaking through each of these zones, and the candle just keeps going and going and going and going. All right, we don't want to see something where it gaps up and then at the open just starts giving it all back. Same thing with Apple. So Apple's just a little different. Not much though, when you think about it. It's a hollow red candle showing that it closed lower than the previous day's low, which makes it a red day, but it closed higher than where it opened, which makes it hollow. We're at 133.25. So we're very close to being outside of this candle already. And the same as the other discussions, the gap up here is really too far away to imagine we're going to get that far today. But as we break through every one of these levels, we've got an expectation that we're going to trigger into some stops. Those are going to add to the buying and then just drive the price even higher, right? Up into the next level and then into the next level. And we do have a market maker move on Apple, and we have a 3% ADR. So you're looking at a 4.5% move today that would not be out of line at all. So from where we closed, 4.5% gets us above 137.5, gets us above 138. I like it. We're certainly primed for a counter trend rally today. One thing we want to check to make sure we're getting the fire is a short covering rally and a lot of those just heavily beat down names. Although there was more than one article that was published suggesting that those are just about done anyways. Let's see if I can remember the bot code. Shorts. All right, Carvana, BBBY, Beyond Meat, MSTR, Digital Brands, Upstart Holdings, Blink, Nokia. So basically the same names that have been on the list, right? I didn't see Wayfair that time, but I don't have 20 like I did on the last one. Well, I only did 10 this time. So, if we were to go back far enough, I'm sure we'd find Wayfair and the others. I want to watch those names today, because if we're going to get a short covering rally, those names are going to make moves to the upside too, right? K-Web, emerging markets, these short names, ARC, that's usually another one that shows up in those short covering rallies. And then, of course, you want to lump all of those meme stocks together, right? You start seeing lots of flow in that junk. It's like chasing trash, right? You start seeing those names moving up too. We're basically looking for a high correlation coefficient, that everything starts running at the same time, right? Just a short-term counter trend rally against the grain. We are at that line in the sand on a lot of these really big names, including the indexes themselves, right? Like 3,800 has to be defended today, this week. So every time we get anywhere near 3,800, we expect to see the market stabilize, build structure, try to pull back up off of the low. Same thing with Apple yesterday, right? It got down to year-to-date lows, and it came right up off of those lows with a lot of defense. You see the multiple tests against that 130 level, and then it came up off of it, right? So same thing. If we come down and re-challenge those lows, it's critical. It has to be defended. After the moves that we saw yesterday, added to, the Russia-Ukraine news from this morning, once they validate that news and actually see a real gesture that they're willing to talk, the market could make some serious moves to the upside. It's one of the two catalysts, right? So otherwise, we're just going to be looking for a mild bounce, short-term rally into resistance, and then a rollover and a continuation on down. And we're getting that Busby on the ES. Right, when you test against resistance multiple times and then finally break out, it pulls back, validates the old resistance as a new support. That's a really big sentence. It's a lot easier to just say it's doing a Busby. Remember, it only owes you back up to the top. So 38.82 is what it owes you. The thing about trend is, if you go back and look at historic trends, they almost always started with tests against resistance, building a base, and then breaking out and validating that old support or that old resistance as a new support. So it's not the idea. I know everybody likes to trade the Busby, catching the bounce, running it back up. Yay. That's fine. But you can also use this as a signal that a trend is about to begin. And just keep in mind that the NASDAQ failed to even get out of the box, right? So it's still range bound. And year to date, I know we don't look at this one as much as the ES, even though I trade it more than I do the ES. Out of the indexes, the S&P looks better than the NASDAQ. So does the Russell. It managed to break out of that same range again this morning. And on the year, the Dow made it through that August high. It has farther to fall than the other indexes. Right. So, we talk about shorting things. We can short everything when the market starts going down, since, a rising tide lifts all boats, and a tide that's going out drops all boats. But how far these things have to fall kind of depends on how far away they are from the lows. The Dow is sitting much higher off of those lows than the other indexes. You look at SPY, it never came close to that August rally. And between that August rally and the October lows, we're not even at 50%, right? We're below that already. The NASDAQ is closer to the October lows than it is to even the 50% mark. It's all about visual, right? That's what I got for you guys. Be careful, be safe, have a good day. I will see you all tomorrow.